All right. So I want to thank everyone for being here tonight. My name is Mark Caesar. I am the host of the Financial Freedom Through Apartment Investing, a proud affiliate of the GOB Network of Apartment Investors. Just want to thank everyone very briefly for all the continuous support on this platform. This would not be possible without all of you. And I just hope that you guys are gaining a ton of value and learning a lot from the various guest speakers that we bring on here. And I pretty much strive on bringing people here that will provide valuable content. And with that said, I have a very special guest here tonight, Anthony Vicino. My apologies. So Anthony and I, we actually connected through a good buddy of ours, Mr. Adam Carswell. What's up, Adam? I appreciate you doing that connection. And Anthony and I had the pleasure of co-hosting one of Adam's protege's podcast not too long ago, which was super cool. So for you guys, it seems like Anthony knows everyone and everyone knows about Anthony. But for you guys who don't know Anthony, he is actually the best-selling author, a real estate investor, and a serial entrepreneur committed to helping people maximize their return on life. He is the co-founding partner of Invictus Capital, a multifamily acquisition firm based in Minneapolis, Minnesota, with 15 million in assets under management that provides busy working professionals with the opportunity to invest better. As the host of the Multifamily Investing Made Simple podcast and author of Passive Investing Made Simple, Anthony firmly believes investing shouldn't be complicated, scary, or overwhelming. With that said, ladies and gentlemen, Anthony, the floor is yours. If I miss anything, feel free to fill in the gaps.
I appreciate it. No, that's a great intro, Mark. I appreciate it, man.
Thank you.
Yeah, I was thinking back when we first met. We met again, Adam Carswell. Shout out to you. He did a great job of mentoring these young kids that are in college still on entrepreneurship and business and like how entrepreneurship, I think, is the coolest thing in the world. First and foremost, like when I talk about what I do with people, yeah, real estate's an aspect of it, but really it's about the entrepreneurship and the fact that it allows us to take control of our own lives and then also to make an incredible impact on the world around us. And what Adam was doing with those kids in colleges is like showing them that it's never too early to start. It's never too early to start networking. And we're going to talk a little bit about real estate investing tonight, but something that I really wish I had like understood when I was those kids' age. And they absolutely crushed it at this podcast that Mark and I were a part of. And so like, that's the preface here. It's like, they just absolutely crushed it in a way that I don't know if I would have when I was their age. But we always talk about start investing early. Like the earlier that you start investing, the more likely that you can get on the right side of compounding interest. And in the span of 20 years, if you put 50 cents away, it's going to be $10 million in 45 years, right? Like we all hear that. And I heard that when I was a kid and I did not do anything with that information. I just kept going, I'm not ready. I'll do that when I have enough money. Kept kind of putting it off until this someday. And then that someday never really came. And I think a lot of people relate to that. But the thing I wish somebody had sat me down and like really put my head on straight when I was like 21, 22 years old, was that it's not just about investing in stocks and bonds early. It's also about investing in your social networks, in the relationships and the people around you, and starting to build social capital and being really intentional about how you cultivate friendships and relationships and networking. And so events like this, not just coming in here and just kind of listening and observing and then kind of creeping off into the night at the end. And also not just coming in and just dropping your business card on everybody, kind of like ninja starring at everybody, but actually saying, how can I get to know you people and stay involved in your life? And if you do that over a 10, 15, 20-year horizon, like the compounding interest of that capital is extraordinary. So that's a long intro to what Adam and his crew is doing, but I think it's something that's super maybe helpful for a networking group like this. So a little background for people that don't know who I am or my shtick. Like Mark said, I'm an entrepreneur, business owner. I've built, my very first business was a high-rise window washing company, which was born out of the ashes of a failed relationship. When my fiance left me, I was $80,000 in debt, living in the back of a van, and I didn't know what I was doing with my life. I was like super, super lost. At this point, I had been a professional rock climber for like a decade, which sounds really, really cool, until you realize it doesn't pay very well. And it really just involves like living in the back of a van voluntarily, which is pretty cool, until you have no option but to live in the back of a van. And then it becomes less cool. So really life is about options and controlling your options. And that's why I think entrepreneurship and real estate investing are so cool. It's got, everybody has the option to get into it. And then it gives you the ability to buy back your time and buy back your life freedom. But at that point in my life, I did not have either of those two things. I was living in the back of a van. The woman I loved had left me. I was really in debt. And I was like, what am I doing with myself here? And a buddy recognized that that was not a good place for me. And he's like, hey, let's go build a business together. And so we built a high-rise window washing company, which utilized our skill set as rock climbers and our network of rock climbing friends, because we could get on these ropes in these areas that other people couldn't. And so we could utilize this unique skill set. And that just set off this love affair for me with entrepreneurship, building businesses, which I think is just a lot of fun. It allows you to have incredible impact, which is, at the end of the day, Maslow talks about how we all have to have our hierarchy of needs met, like our physical needs. You got to be, fed, and you got to be sheltered. You got to be clothed, even if that's in the back of a van, eating ramen noodles. Like, you got to have that met before you can start working your way up the ladder towards self-actualization. And for me, real estate investing was an avenue for moving up that ladder towards making a bigger impact on the world at large. Because I think one of the really cool things, and I don't know where everybody is on their journey in this room, and I'm really curious to kind of get to know and learn about your guys' experience and where you are. But I think a lot of people, they get into real estate investing initially because you can make money, right? Like, most people get into real estate because they're like, best way to get rich I've ever heard of. And it is. It's the best get rich slowly but surely plan I've ever seen. But at a certain point, it becomes less about the money, because the money no longer becomes the issue. And then you have this bigger conversation about, well, what's the impact that I'm having on the world around me? And you guys might discover this by accident, but real estate, I think, is one of the coolest and best ways to have a positive impact on the world and the communities around us. So if you're an apartment investor, for us, we're vertically integrated, which means that we get to serve our residents, our families, on a day-to-day basis in terms of leasing, maintenance requests, and actually like getting to see these families that live on our properties. And that's one way to really make an impact on the community. The other way is for our employees, because a lot of people, they're working jobs that they hate, right? Like, if you've ever worked a job you hate, like, it doesn't matter how many hours you work in the day, it's too many. If you hate what you do, it's too many. And so what we strive to do is, like, let's create an environment where our employees are really psyched. Like, even if they're just leasing a unit or just doing a renovation or a turn on a unit, how can we make this into a thing that has impact and meaning for that person, where they can connect it when they wake up in the morning and go, I'm excited to go do that because it's serving a larger purpose. And then the last group that we get to serve is our investors. And that's what I'm going to talk about a little bit today, is the passive investing. Because for me, real estate, I have 6 brothers and sisters. Well, I have 6 sisters, 2 brothers. I always get this wrong. My dad corrects me every time. He's like, can you not count how many siblings you have? I'm like, Dad, I can't count past 5. It's too many. Like, you should have stopped. So I have a big family, and the general financial literacy of my family is probably no different than the general public's, which is unfortunately not very high, right? Like, we weren't really taught what to do with our money when we were in school. At no point did anybody ever sit us down and say, here's how to build generational wealth. So I kind of figured that out on my own, and then realized, okay, here's a way that we can bring the rest of the family into this and provide these really cool investment opportunities into what we do, specifically our multifamily apartment buildings here in the Twin Cities. Shout out Minnesota. Janelle, I know you're on that train too. We rock. And so the passive investing, I think, is, I want to talk about that today, because we wrote a book on the topic, on a mission to, here's the thing. When most people think about real estate investing, they don't think it's as cool as we all do. Everybody in this room probably thinks it's way cooler than everybody else who you talk to. When you talk to your family, your friends, they're probably like, yeah, real estate. they're probably a little bit scared, a little bit overwhelmed, because when it comes to money, it comes to investing, those are scary, overwhelming topics that have been designed to be such, right? Like financial services wants us to feel overwhelmed when we think about investing. So then we outsource the investing to the professionals. We get our financial advisor, we get our stockbroker, we get these people to step in and do it for us. And when we do that, we become at their mercy. And they might not be doing what's best for us, but we don't know better, right? And so my whole perspective is that investing is not very difficult. It's not very complicated. And passive investing in apartment syndications in particular is quite simple once you understand some key components of it. So regardless of where you guys are in your journey, I think there's probably a good number of you who are apartment syndicators that want to be operators, that are operators. And maybe there's some of you that are just now starting to think about apartment investing or maybe interested in being passive. So what we did, we wrote a book called Passive Investing Made Simple, came out last month. And it's all geared towards two people. One is people who really should be passively investing in apartments. And depending on where you are on your journey right now, you might not yet realize that that's you, right? Like some people come into investing in real estate thinking, I need to do everything. I need to be active. They get into it and realize, holy crap, this is actually really hard. I don't like working with tenants and residents. I don't like any of the hard work that comes with it. And they would have been better served focusing elsewhere. So that's one group, is like, oh yeah, absolutely, Daryl. I'll put the link in. You can go to thepassiveinvestingbook.com for anybody that wants to go check it out. Or if you guys want a free copy, just shoot me an email, Anthony@invictusmultifamily.com. I'll send you a free copy. So save your money. It's like $4. I'd rather give it away for free, and then you can give it after you're done with it. Give it to somebody else who it would serve. So that's one person, is the potential passive investor. Now, the potential passive investor has no clue, if they're anything like me, they have no clue that this is an investment vehicle that's available to them. No clue. If you sit and ask somebody, who owns the majority of these apartment buildings around us, they will stare at you like a deer in the headlights. They will have no clue. And rewind 7 years ago, that's what got me into multifamily, was that question. I looked around one day and I was like, who the hell owns all these buildings? And it wasn't until like that moment of asking that question that I realized I had no clue, but I assumed it was like really, really rich people or institutions. And in diving into unpacking that, I realized actually it's a lot of people just like us doing what's known as a syndication. And we're going to break down what a syndication is, all the different roles in it. Now, the second group that this book is designed to help is operators who are struggling to communicate to their investors or to their family in a way that conveys the message of how awesome this is. Because when you first start talking about multifamily investing, people are going to think you're crazy. They're going to look at you and be like, okay, yeah, that sounds great. And cool. I'm not interested. And it's because you're using terms and concepts that people have never thought about. They have no context for, and it all feels overwhelming. So our job is to simplify, because the confused mind says no. And at the end of the day, what we are trying to do is we are trying to serve our investors by first leading with education, never sales. We're never trying to sell anybody on real estate. We want to educate them, because once people understand how powerful this vehicle is, how stable, how secure, how accessible, they sell themselves. The light bulb goes off and they go, okay, I can do this. And so that's our job as an operator, as a capital raiser, as a syndicator, is educate people so that they can step into the light themselves. We're not trying to force anybody into it. So that's number one. Mark, do I have screen share ability?
1 second.
Oh, sweet. I like to make things simple with pictures. So the first question that we're going to get from everybody when we sit down to say, hey, first of all, when somebody asks you, what do you do? How do you answer? Like any syndicators out there, how do you answer?
That's not all the answer at once now.
Yeah, anybody?
Real estate investor, help people generate passive income.
Cool. How do you do that?
How do you generate the passive income?
Yeah, so you're a real estate investor helping people generate passive income. And I'm a new investor. I'm like, cool. So what's that mean? How do you do that?
So we provide the opportunity for people to invest in an apartment complex that they normally couldn't do on their own because it's too large of a deal. And we partner everybody's funds together and do a deal together where we all share the profits.
Cool. So there's this partnership aspect, right? So most people, when you first step into like explaining what a syndication is, if you use the word syndication, they're going to be very confused. So what you have to do is you have to outline from a very basic level, what are the fewest number of moving levers? And so that could manifest as, so every deal needs three things. It needs somebody who has the time, somebody who has the experience, and somebody who has the capital. Now, not all three of those things need to come from the same person. Now, what we do is we go buy buildings that individual investors could not do on their own. So we partner with people, some of who bring the time, some of who bring the experience, and some of who bring the capital. And together, we pool all of these resources to go and acquire these big buildings together so that we can invest like the large institutions do and how the really ultra wealthy do. But we can do it without having to take on all the risk, all the work, and all the rigmarole on ourselves. And so the role that we fill as the syndicator, let me pull up a thing here. All right, can everybody see? We got a watered down little graphic here for everybody. Nice and simple. Yeah, Janelle, I'm getting thumbs up. Cool. So a syndication is a group of investors pooling their resources to buy a large asset and split the profits. Super simple. So start there, because anything more complicated of like value add multifamily, it's going to go right over people's heads. And the first thing that people are going to be concerned about is like, well, one, I don't have that much money. Two, this has to be risky. Three, I don't know where I have the money. Like I can't get into these things. And so once we start walking through the different aspects of a particular deal, we need to anticipate, preempt, and prevent the fears or the concerns that a potential passive investor is going to have. And the first thing that everybody thinks of when they think of real estate investing is it's risky. And that's a function of 2008. Thank you very much. Global meltdown. That's what happens when the market just kind of does a nosedive. Everybody is afraid of real estate. Now, when we're talking about risk down here, there's two different categories here. One is the risk that the general partners are taking versus the limited partners. And that's a distinction that you're going to have to explain, is that limited partners are the passive investors. They don't do anything. They just fund the deal. And the general partners, they're the guys and gals doing all the work. So split that into people's minds. And those carry two different types of risk. But to the limited partner, the important thing here is the risk that they take on is very, very low. And it's very, very low because, one, they're not signed on any bank loans. And that's very nice, because if the deal does fail for some reason, the bank can't come after all their personal assets, which is not the same as for the general partners. Now, every investment is inherently risky. There's no such thing as a guaranteed return, no perfect return. And so there is a little bit of risk, but it doesn't extend any further than the potential of losing your initial investment capital. Now, I don't want to assume that everybody here is a multifamily investor, but I will probably assume that you guys are all commercial in some way. The important distinction for most passive investors is to help them understand that not all real estate is created equal. And what happened in 2008 very largely impacted the single family market, much, much more so than the commercial market. And it's going to be different depending on your particular market. But generally, multifamily during 2008 through 2011 didn't really see significant foreclosures. It was less than 1%. We didn't see significant drops in value. And if anything, we saw some stagnating rent. Now, the reason that this sector didn't get hit in the same way that single family did is because the valuation model is entirely different. Now, for those who aren't familiar, and this is something that you're going to really want to sell home to your investors as you're having these conversations, because this is one of the things that once they get this is one of the light bulb moments, is that the way that single family properties are valued is fundamentally different than how large commercial properties are valued. And that's where the magic happens. For me, I started my real estate journey with a triplex. I house hacked that bad boy. I put $7,000 down. I bought it for $246,000. A month later, I was dealing with bounty hunters. It sucked. But 9 months later, it refinanced for $125,000 more than what I paid for it. So in 9 months, it appreciated over $100,000. And you would look at that and think, wow, Anthony is a genius investor, but you'd be wrong. I am a lucky investor because I did nothing to earn those returns. It was all organic appreciation born off the back of the fact that my building was valued based on comparables, which means the neighbors, what they sold their properties for dictated the value of my building. That's all. Like, it had nothing to do with me. So I could have been a slumlord, doesn't matter. I could have been the best operator in the world, doesn't matter. It's going to appreciate how it appreciates. Now, the difference with multifamily is that we do control the valuations to a degree. It's based off of the income approach. And so they're valued like businesses, which gives us a lot of control to go in there and improve revenues and improve expenses. And by doing so, we make our buildings more valuable. And it's because of that, because our buildings are valued as a result of their revenue generated, their net operating income. That's what the banks are loaning against. And so in the financial crisis in 2008, we really didn't see the market getting turned upside down like we did with single families, because the underlying way that these buildings were valued wasn't based off of what the neighbors were selling it for. It was based off of what the buildings were worth, right? Like, how much cash flow are these things generating? And so right there, when we're talking about commercial, we really want to help understand that risk profile, because that's one of the biggest things everybody's concerned about. And it should be. Warren Buffett says rule number 1 of investing is don't lose money. Rule number 2 is, I don't know, something about don't forget rule number 1, right? Like, it's that important. Don't lose money. Principal preservation is everything. So number 2, let's talk about time. Time is an interesting one. Some people would say it's our most valuable asset. I disagree. I think our attention is our most valuable asset. You don't actually control time. You don't own time. You can't give me 2 minutes of your time. You can only give me 2 minutes of your attention. But time is very valuable in the sense that you're not getting it back once it's gone. You only get so much of it. And this is one of the really valuable things about this model for most people is you have to think about what's the highest and best use of your life. Where are you designed to serve and make the best impact? And that's the thing that I'm fascinated with is if every day, everybody in the world just got to wake up and try to solve the problems that mean the most to them without having to worry about where their next meal was coming from or how to pay their bills. If they could just forget all that stuff and just focus on solving problems that mean the most to them, imagine like what we could accomplish as a group. And so that's what I want people to take away is that like real estate, being an active investor isn't for everybody. Some people are way better served going and solving other problems. I'm really good at solving toilet problems, so I'm in real estate. But if you're really good at solving heart problems, you might be better off being a doctor and saving the world that way. And so a little bit of self-awareness goes a long way, but regardless of which it is, if you have something else that you'd rather be doing with your life rather than dealing with real estate, then passive investing is going to be a very good option, because after you've vetted the operators, which is the most important part of any deal, the operators. Once you've done that, everything becomes very, very easy and low barrier to your time. Now, why is the operator the most important part of the deal? It's because of this. This is the home baked analogy straight from Anthony. Nobody else has ever said these words. Actually, I don't know. They might have. A good operator will take lemons and they will make you lemonade. A bad operator will take your lemonade and spill it on the floor. And this is the analogy to really keep in mind when it comes to operators, is that you could have the best deal in the world, but if the operator lacks the ability to execute, it's going to be a terrible deal. And a great operator, they can take a mild, mediocre deal. And if they're an awesome rock star, they can maybe make that into a great deal. At best, they can make a great deal. At worst, they're not going to make it worse than it was. And so that's what we're betting on when it comes to this. It's not about vetting the deal. It's less about the markets. It's about the operator. Like, bet on championship level operators and you'll never go wrong. And when you do that, once you've done the time, the energy of vetting and talking to different operators, like go talk to Trevor, like get to know him. That's going to take a while to build up the trust and rapport and be like, I believe I can give this man my money and he will do right by it. That's going to take some time. But once you've done that, vetting future opportunities that Trevor brings you, it's not going to take very long because you've already done the hard work of vetting him. Now the capital, majority of the time, the passive investors are bringing almost all the capital. I'm a firm believer, for the sake of creating alignment of interest, that general partners should also co-fund their deals. If the deal is good enough to put somebody else's money into and take their money for it, it's also good enough for your money. So why isn't your money in there? That's my question. It could be for certain liquidity issues that the bank wants to see you have a certain amount of net worth after closing. But by and large, I like to see operators also putting their money alongside their investors, because here's the thing. Like, I started this whole rant because that's what this is at this point. I'm just ranting. I lived in a van and I was really, really in debt. And I remember just how far a dollar would go and how much that could buy you in ramen noodles and how much gas that could get you. And I remember having to do the mental jujitsu of weighing the pros and cons between putting gas in my car so that I could have heat because I was living in it versus eating. And so a dollar can mean a lot of things to a lot of people. So when somebody gives you their money, they're not just giving you a dollar, they're giving you what they exchanged to achieve that dollar, to receive it. And that was their time. They gave time to get that dollar, time that they'll never get back, time they can't spend with their family or their friends or do any of those things. So when somebody gives you $50,000, it's not $50,000. It's $50,000 worth of their time. And that's a sacred, sacred responsibility. And I think a lot of people want to get into syndications because it's the sexy, easy way to buy millions of dollars of real estate without having any money of your own. You can scale really quickly. But I want everybody just to take a moment before they ever take somebody else's money to really think, one, can I do right by this? Do I legitimately have the skills to do right by this money? And if the answer is no, that's okay. Go get the skills on your own dime and then come back and take people's money until you can look them in the eye and say, I can do right by this. Because the majority of the capital, it's coming from our passive investors. Next is the tax benefits. Here's the interesting thing. We talk a lot about tax benefits. You hear this a lot. I think if you guys are spending any time in the active syndication world, honestly, the tax benefits to a passive investor that is not a real estate professional, they're okay. They're good. They're better than the stock market. Like, they get to pass through depreciation. They get to keep more of their cash flow in the interim, but the tax man always comes due. He's always going to want his money at the end. You can't, it's hard to do a 1031 into these types of deals. And you're not really going to be able to offset your active income for most passive investors with the tax benefits. So the tax benefits are great, but I think sometimes we oversell this aspect a little bit. And then we get our passive investors coming in being like, I'm going to pay zero taxes. Like, pump the brakes. You probably won't. That's probably not actually realistic. So I would like just to see everybody just kind of tone down the tax language just a little bit when it comes to syndications. They're great. Don't get me wrong. Better than the alternatives, but it's not the golden goose. Control. So here's an analogy that might help you communicate to somebody just off the street. I challenge you just to walk up to somebody on the street and be like, I'd like to try and explain a concept to you. And let me know if this makes sense. If you do that, you're going to be a really good salesperson. I can guarantee it. So here's the jumbo jet investing analogy. Instead of starting with the real estate, let's think about how easy it is to buy a plane ticket if I want to fly from New York to Paris. I don't need to go and get my pilot's license. I don't need to go buy a plane and then fuel it up and then fly my ass all the way across the ocean. I can just get on Expedia and buy a ticket and like 2 hours later, I can be on a plane. And I can be on a plane with trained professionals and flight attendants and pilots and ground control people who've spent their entire life like learning and mastering this thing. And they're going to do all the hard work. And I'm just going to sit in probably economy class because I'm really cheap. And I'm going to eat my peanuts and I'm going to be in relative comfort. I mean, as much as possible on a plane, but I'm not going to have to do anything. And I get to like just sit there and watch my movies. And then when I watch my stories, when I get to my destination, I get off. And that is passive investing in apartment buildings in a nutshell. Like it's no different. Passive investors, they buy their ticket into an investment opportunity. The GPs, the active investors, are a lot like the pilots, the ground control, the maintenance, the flight attendants who are taking care of everything, and you just sit back and you enjoy the peanuts. So when it comes to control, though, there will be a segment of your investors who look at that and go, I don't know if I want to give up all my control. That sounds scary. But here's the thing. When there's turbulence on that plane, do you want to poll the audience as to what you should do? No. Like, if I'm part of that audience in the back of that plane, you don't want my opinion on what to do with that plane. You want the pilot's opinion. And so you want the people who know what to do to have the control so that they can make the decisions that are in the best interest of the deal. And so giving up the control, while it sounds scary, it's actually a very, very good thing. And finally, profits. Now, here's the thing is that the majority of the profits are actually going to go to the active investors on the deal because they're doing all the work. It's their income. So that makes sense. But as a passive investor, you're going to make really good returns, like the type of returns that are very, very hard to match in any other investment vehicle that I've yet to see, short of crypto, which I don't know. My crypto isn't doing so hot these days, guys. I don't know about you. Mine's struggling. So that is, in a really oversimplified nutshell, the syndication model, and a lot of the struggles, a lot of the questions, and a lot of the hurdles that you're going to have to overcome to get somebody to a place where they're comfortable giving you their money. And it should take a while. Like, honestly, at Invictus Capital, we have, God, what do we have? Like $30 million in assets under management. We've raised about 10 million this year alone. It takes about a year and a half from the moment somebody first even sees my face or Dan's face or hears our podcast or reads anything from us. It takes them like a year and a half before they get comfortable enough to go, I'm going to give you my money. And I would expect nothing less. And so when you're first starting in this business, recognize, again, it's what I said at the very beginning, real estate is the best get rich slowly but surely plan there is. Reset your expectations. If you're thinking that you're going to be out of your full-time job in 6 months, probably not what's going to happen unless you're cutting some corners and you're going to find yourself, buried under an avalanche of sawdust. And so don't do that. Just recalibrate the expectations that this is going to take a while, but you're going to play that game. You're going to play the long game. You're going to be in it for 10, 15, 30 years. And on that time horizon, you can't help but win. So just be patient and recognize that this is, you're in it for the long haul. So I am done, Mark. I'm done ranting. I'm done raving. Unless you have some questions, I can get back to ranting.
That was my $2,000 worth of info right here, because I love the airplane and the airline analogy. That just like solidified a lot of things for me. And I think with your permission, I'm definitely going to borrow that and use it.
Oh, definitely.
Yeah, because I talk to a lot of people on a day-to-day basis. And as you alluded in the beginning, when you directly just approach someone and just tell them about syndications, it really goes over their heads. So a lot of people, like, they're looking at you like, all right, like there's in headlights. But now that I understand how to just break it down to the minutia and help them and educate them with something as simple as, okay, I'm the pilot and you're the passenger, you're just enjoying the peanuts and you're trusting me to navigate you, that will definitely resonate with them, and they'll have a basic understanding. Okay, this is what this asset class does, and this is how it's beneficial. So I appreciate you sharing that. Does anyone? I'll open the floor to anyone. If you have any questions for Anthony, feel free to unmute yourself and ask your questions. Let's not all raise our hands at once here. Guess no one has any questions. That's quite interesting. That's the first.
Nailed it. That just means,
yeah, that's perfect. But all right, so I'll kick it off. In regards to that, I know you said that it takes you about a year before people actually warm up to you and say, hey, I want to give you my money. Like, what's typical conversation with potential investors, whether it's a busy professional or grandma or grandpa who has some money under the mattress somewhere?
Yeah, the starting point is always understanding what's their desired outcome. It's don't lead with what you're selling, try and figure out what it is that they need to buy, and then reverse engineer whether or not you actually have the product for them, because we deliver a very particular type of product that might not be right for, I would say, the majority of investors, but for the people who it is right for, it's perfect. And so the first conversation is understanding, what is your goal? What is your desired outcome? And then trying to understand their investment parameters, their risk tolerance, their return expectations, what kind of timelines that they're operating with. And it's only in asking those questions and getting to understand people's unique needs that you can, really figure out, can I actually serve that? And if the answer is no, then you should walk away or refer them to somebody who can. Like, it is better to say no to taking somebody's money that you can't serve to the utmost of your ability than it is to take it and hope maybe you can deliver 70% of what they expect. Like, you will live and die in this business based off of referrals and reputation. And if you're not delivering 100% like exceptional to somebody, then they're not going to be a raving fan. And that's not what you need in your camp. If you want to grow, you need people who are raving fans. And the only way to have raving fans is to over deliver value. And if you can't do that, then that's okay. Walk away from that investor. I think too many people are afraid because in the early days of raising money, it's so hard and you have so many conversations. It's so uncomfortable. And by the time you finally are like, you've crossed that first hurdle of asking for somebody for money, then you're like, I'll just take whatever you give me. Right. And you come from this position of desperation and weakness rather than recognizing that you, as the deal finder, as the deal provider, you are the unicorn, not the person with the capital. Like, deals are way harder to find than capital, especially in the last year and a half. There's a lot of money out there right now. So change the conversation in your own head from one of saying, I need your money, to, hey, I have a deal. I am the bell at the ball everybody wants to dance with.
Awesome. Now, another question I do have, when you're talking to investors, so do you initially tell them, once you have their criteria and what they're looking for, do you initiate the fact that, hey, this is what can happen, with an investment, this is what has happened to me, just to sort of put their mind at ease? Or do you wait for them to ask you, okay, what's the worst that can happen?
People connect with vulnerability. First and foremost, like, here's something that I really struggle with, is this idea of selective vulnerability. This idea that I used to, and I still do, I struggle with this a lot because I have an ego and I want to be perceived in a particular way by the people around me. And so what that means is we tend to share things like that we think are negative, but we do it in a light that then allows us to leapfrog towards success. So we share our failures that ultimately led to a success, because it's really just the placeholder of that story, rather than genuinely just sharing a failure that didn't really lead to a success. Maybe it led to a learning opportunity. Like, that's vulnerability, when it's not just selectively leading towards a success. And so I think it is important that people recognize, like, I'm not a machine. I can't guarantee your returns. I'm not a fortune teller. I'm not perfect. Like, for every business I've had that succeeds, I can point to another one that failed. Like, that's the game that we're playing. And if you expect me to be perfect, well, then I can't live up to that. And that's going to be a bad foundation for us to start this relationship. But if you can realize that I am fallible, that I do mess up, but that I learn from my mistakes, I grow from my mistakes, and I do everything in my power to do right by you, then you can bet on me to always have your best interest in mind, regardless of what happens, because 2020 is going to happen again. Maybe it's not a pandemic next time. Maybe it's a dinosaur comes back from, extinction and takes over the world. Like, who knows? It could be anything. And so it's not about who never strikes out. It's about who strikes out, who learns, adapts, overcomes, and comes back better the next time.
Awesome. I appreciate you sharing that. Again, the floor is open. If anyone has any questions for Anthony, feel free to unmute yourself and ask your questions.
I'm also a dinosaur expert. I was when I was 8. So if you guys have questions about that.
Understood. All right. Seems like no one has any questions. So Anthony, I do want to thank you again for your amazing presentation and the education. I for sure took a lot out of this, and I will definitely apply a lot that I've learned today into my investor database when I'm speaking with potential investors. You're more than welcome to hang out if you can. We'll do a few breakout rooms so people can get connected and network. If not, feel free to drop off. With that said, we will end this recording.